there's something really exciting going on too. And that would be, in my estimation, the opportunity in the tech sector. Definitely more volatile, but I got to tell you, Rob, I called Rob actually the other day. I had to go to the Apple store to get one of the kids' computers fixed, and my son had been just dying to see this Apple Vision Pro, and somehow he signed us up for it. So I go in, and he's so excited. I'm like, yeah, whatever, right? Like, I got to put this thing on my head and look like an alien. I was blown away. I was absolutely blown away. Rob, right? I called you, and what did I say? Gosh, I feel good about technology because I actually think there's so many ramifications of this stuff that like this is actually going to be huge in ways that people have not even thought about. This is first generation Apple Vision Pro. Other companies are trying to do this too. I mean, you've got the metaverse, right? That's coming along. And what did Facebook rename itself? Meta. So I think that Zuckerberg, obviously a smart guy, is a big believer in this too, and many, many more. I'm going, wait a second. Like for anybody who thinks that semiconductors are overvalued, I get that there are headwinds there, and I get that maybe somebody wouldn't choose NVIDIA. I know that we haven't chosen it, for example, in our growth-oriented American resilience portfolio. But Rob, like they're going to need a lot of chips. They're going to need a lot of semiconductors. They're going to need a lot of space for the semiconductors. I mean, it's incredible.
Yeah, AI, it's just incredible how much AI has become such an important variable now in the stock market overall. I would estimate, just look at the S&P 500 now. It's about over 30% just tech stocks. So there's 11 sectors, 1 out of 11, information technologies to over 30%. The Mag 7 are over 30%. Actually, 4 out of the Mag 7 are not tech stocks. Technically, they get classified as something else. So, by my estimate, it's like half the market is really like in one way or another, like a more or less direct AI play. And then much of the rest of the market is kind of an indirect AI play. So AI is like the most important thing happening in markets today in the economy. Hundreds of billions of dollars are being deployed to build out our AI capacity. I think, with the audio, video, VR goggle experience you just had, but that's pretty incredible. But it's also like
it's one sliver.
It's like a little sliver of what is going on here between, because they're just more on the data and like the accessing big data and the ability to do all of this supercomputing for just a vast array of purposes, self-driving cars. And, if you listen to the experts and to the leaders in the area, they're all saying the capabilities that we have within AI are like, exponentially growing, so we're just in like the early stages of what's possible.
I see it. And I see it every day. Like, even in terms of, the thumbnails, for example, we don't use them, but I have colleagues that do. And you don't even need to submit a picture of me. Like AI will find a picture of me and create a whole thumbnail. And it's sort of like, wow, it's incredible. Like, it's scary too. I get it. And wasn't there a pretty big firm that just came out and kind of panned it and said, oh, it's not all that, blah, blah, blah. Some people were sending me this article. I'm like, well, it kind of is, but.
Over the last, we've had a little bit of a wobble. This week we had a bit of a recovery, but in the past few weeks, we've had a bit of a wobble, particularly in tech stocks. And there's a bit of a concern now, kind of justifiably within the market that, are we in a bubble? There was a venture capitalist out of Sequoia Capital who kind of published a well-read note, kind of questioning if there's this, kind of revenue hole. Like, you've got hundreds of billions of dollars going in to build out the AI processing capability, but where's the beef, right? Like where are the applications? Where's the revenue? Elliott, the hedge fund, this was an article in the Financial Times. We got a hold of the letter, talked about it in the most recent 76 report. They took a very curmudgeonly kind of bah humbug approach to the AI situation and really likening it to the late 90s, the tech bubble, the tech and telecom bubble, and the massive overbuilding that went on in that era. And I think it's very much a concern. Are we overbuilding? Are the animal spirits, running too fast here? And are we overvalued in a lot of respects? and you look at a stock like NVIDIA, kind of going to the moon, that's any value oriented type investor will say, hey, I've seen this movie before. This is something to worry about. But on the other hand, these technological changes are very real, and the possibilities are somewhat endless. And, my attitude is you really just got to be very mindful of the risks, but think very carefully of like how you want to be positioned. And I'll give you an example. NVIDIA, right? So NVIDIA right now has 65% operating margins with growing revenues. They have tremendous pricing power because they're really like the only game in town in terms of these graphic processing units. Mm-hmm. There's some competition, but over time there could be. I mean, the history of technology is that, particularly in semiconductors, is that new competitors arrive, and you don't have that kind of window of pricing power, so that erodes. But the flip side is, if you think about that scenario, if GPUs get cheaper because there's more competition and it becomes more commoditized, and they're just going to get better over time, that just means there's more AI, right? There's more AI, there's more ability to deploy AI. That you can make more data centers because you get more GPUs for your dollar, right? When you invest, when a big hyperscaler like a Google or Meta invest billions of dollars in data centers, they can build bigger data centers, right? So like then there's a downstream effect. And this is similar to what we wrote about in the 76 report, where all those companies that built all that fiber capacity in the late 90s, that was bad for them. They, investors in those companies lost out, but investors in other parts of the internet really benefited from that excess capacity.
Which is in part, and I'll just put this graphic up again for people to take a look at. You should go to 76 Research, 76research.com, because we actually wrote a special piece on this today, specifically on some of the things that Rob is talking about. But the other thing is, in terms of our American resilience portfolio, what we've tried to do is identify those opportunities around sort of not the NVIDIAs. By the way, you can get NVIDIA if you invest in the S&P 500, and be aware of that, right? If you're investing in the S&P 500, you are getting NVIDIA, which is pretty volatile. But there's opportunity, to Rob's point, in this space without actually being in NVIDIA, but looking at sort of the other players. And can we give any names? Is that kosher? I know that they're supposed to go but I think that we did put out a note on one. I'll let you do. Can we talk about that?
No, I mean, we have a few stock ideas in the
digital, really.
$1. You can see our four kind of stock ideas in the most recent 76 report. Use that code word dollar to subscribe. And we kind of walk through.
This is a generous guy. I did not know that was back on. I kept saying we need to do that for back to school at least. No, that's great. Yeah. $1. So you're right. You're going to get like 4 really, really big meaty ideas. So code word dollar, DOLLAR.
Several of our model portfolio ideas have been profiled in the 76 report. So for $1, you can sign up and read all about it. You can start with the most recent piece on AI if you're specifically interested in this topic. But I think look, if you own the S&P 500, you're going to own NVIDIA, and you're going to own the other major, what they call hyperscalers, the companies that are making these big investments in AI. And these are great companies. Maybe they're somewhat overvalued, maybe they're not. If you own the S&P 500, you're going to own them in a pretty significant way. I think there are other companies out there that offer you other forms of exposure to AI that might have more subdued valuations,
right?
And might not be as exposed to that risk of the possibility that we are in a late 90s style kind of overbuilding of capacity. But they would benefit from, this AI revolution is not going to stop, whether or not.
I would just say, so I tend to be, not to toot my own horn too much, but like I tend to be pretty on the news curve in terms of identifying trends, et cetera. I would say I was actually the first journalist, the first reporter to ever witness Bitcoin being used as legal tender. And it was happening at a nightclub in New York City. And I somehow got wind of this because I was really into Bitcoin. Like back when it was $10. Okay. Like I was like, this is very, very interesting. And even philosophically, I remember actually talking to Carl Icahn about it. And he was like, wait, what? He'd been a philosophy major at Princeton, your alma mater, of course. And yeah, he was like, this is fascinating. I'm like, I know, it's really fascinating. And I'm getting into the, the legendary so-called Japanese guy that created the stuff and everything with him. And he's like, what? Anyway, I was there when they took the first legal tender of Bitcoin. I drove my entire crew crazy. I was at Bloomberg. It was a rainy night. It was like a Sunday night. And I made everybody go in and go see this. And I was like, this is history being made. And they're like, whatever. I'm like, no, you don't understand. And that's how I feel right now, all over again, about AI, ChatGPT, Perplexity, like all of these new incarnations of things that we are seeing, all of these programs where so much is being done. And sure, like it's a little bit scary. Bitcoin's a little bit scary too. But I tend not to be scared about these things. I get excited about them. And I look at it, again, everybody has a different tolerance for risk. Everybody. And you need to understand your risk tolerance. But, if you have a little bit of sort of on the side and you're willing to take these chances, I think taking informed chances, which is what we're offering people for $1, DOLLAR, use code word dollar. I think the first 2 months, actually it's just $1 a month and then it's $9.95. So it's actually really, really, really smart to do. But for that sort of opportunity to be in some of these places and in some of these stocks, I think is really smart long-term stuff.
It's just open-ended. I mean, look, there is valuation risk. Maybe it's overextended. We can navigate that, but it's like, you could have said the same thing 10 years ago and look at how all these big tech stocks have performed. So, being, kind of calling everything a bubble and being a big skeptic.
You don't make money that way.
What's that?
You don't make money that way. And by the way, look, hey, we like gold too. So in other words, you have safety, right? Like, what did you say?
No, gold broke 2,500 today. It's at an all-time high. No one's really talking about it. There's so many other things to talk about. And interesting, it's in the context of Kamala's 1970 style Kamala economic plans, right? Like, now we, just like the 70s, we see gold pressing new highs. But yeah, gold, I think, isn't actually a really interesting, counterbalance to a growth portfolio, right? Because, okay, let's say this is a bubble. This is some kind of tech bubble like the late 90s. What happened after that bubble burst? Interest rates came down. We entered a recession, and that's a scenario where gold will do well, as it's no longer competing with like high interest rates, interest bearing securities. So you want to, and you can also own. In our income builder portfolio, we have a number of stocks that would do well in a falling interest rate environment, in a more kind of recessionary, type of scenario. I think it does make sense to kind of balance, have a balanced portfolio, have your growth investments, have your AI investments, but then have good, solid investments that would be sensitive to other kind of trajectories in the macro economy.